On January 25, 2019, AbbVie Inc. reported fourth quarter earnings and full year results for the period ending December 31, 2018. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about AbbVie's business model. AbbVie is a global pharmaceutical giant that was spun off from Abbott Laboratories in 2013. The company's primary source of revenue is Humira, which is a multi-purpose drug. Humira is the best-selling drug in the world. AbbVie has a market capitalization of $119 billion, with annual revenues nearing $33 billion. AbbVie is one of the world's most popular dividend growth stocks. The company's current dividend yield is 5.3%. Moreover, AbbVie is a consistent dividend grower. Including the years that AbbVie was a part of Abbott Laboratories, the company has increased its annual dividend payment for 47 consecutive years. AbbVie has increased its dividend every year since the spinoff was completed. Because of this, AbbVie is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with 25-plus years of consecutive dividend increases. In fact, AbbVie qualifies to be a dividend aristocrat nearly twice over. In a few years, the company will become a dividend king, an even more exclusive group of stocks with 50-plus years of dividend increases. Looking ahead, investors interested in owning AbbVie stock will likely be interested in the safety of the company's dividend payment. For the remainder of this video, we will discuss AbbVie's dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss AbbVie's dividend safety in the context of the company's current earnings. In the fourth quarter of fiscal 2018, AbbVie generated adjusted earnings per share of $1.90, which compared quite favorably to the $1.48 of adjusted earnings per share in the same period a year ago. For context, AbbVie currently pays a quarterly dividend of 96 cents per share, which implies a payout ratio of 51% in the most recent quarter. Looking out over a longer time period, our conclusion is the same. AbbVie generated $7.91 of adjusted earnings per share in fiscal 2018. The company distributed $3.59 of common share dividends during the same time period for a dividend payout ratio of 45% in the full fiscal year. Using earnings, AbbVie's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare AbbVie's current dividend payment to its free cash flow. AbbVie generated $3.4 billion of cash flow from operating activities in the fourth quarter of fiscal 2018 and spent $123 million on capital expenditures during the same time period, for free cash flow of approximately $3.3 billion. The company distributed $1.5 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 45%. Looking out over a longer time horizon, the company's payout ratio is very similar. AbbVie generated $13.4 billion of cash flow from operating activities in fiscal 2018 and spent $638 million on capital expenditures for free cash flow of approximately $12.8 billion. The company distributed $5.6 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 44%. Using free cash flow, our conclusion for AbbVie's dividend payment safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow and we see no risk of a dividend cut in the near future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze AbbVie's current dividend safety in the context of the company's historical recession performance. Unfortunately, AbbVie was not a standalone entity during the last recession, so it's unclear how the company would have performed during the 2007 to 2009 time period. It stands to reason that AbbVie would hold up fairly well in the next recession because healthcare is a necessity. Consumers will seek out treatment for illness regardless of the economic conditions. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess AbbVie's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of fiscal 2018, AbbVie had $36.6 billion of total debt outstanding. The company generated $380 million in interest expense in the most recent quarter for a weighted average interest rate of 4.2%. The following image shows how changes to AbbVie's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, AbbVie's weighted average interest rate would need to rise above the 23.8% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on AbbVie's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on AbbVie's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.